Hello and welcome to Euclid Academy. In this lesson, we're going to talk about financial ratios. This is an accounting lesson on Euclid Academy, and we'll have this series of accounting lessons. The first one, we want to talk about financial ratios, and it's just part of financial ratio analysis. So, what are the types of financial ratios that we're going to talk about? So, number one, we just talk about the liquidity ratio, basically one type of liquidity ratio. Then number two, we're going to talk about the efficiency ratios, about two types of efficiency ratios we talk about, that the fixed asset turnover ratio and the turnover ratio. So let's start with the first type of ratios. There are different kind of ratios in accounting, and most of them can be confusing, so I'll just try to put them in groups in this series of financial ratio analysis, and then we will be able to understand them one by one. We'll look at the ratio, and we'll also look at an example on how to calculate that ratio. So let's start with the first ratio that we're going to talk about, which is a liquidity ratio. So what is a liquidity ratio? Liquidity ratios basically measures how good a company is able to cover its short-term liabilities or short-term expenses using if it has got enough cash to pay for its short-term liabilities. So that is a liquidity ratio. How fast can how what's the measure of the ability of the company to pay the short-term debt? So the type of liquidity ratio that is normally used, which we're going to talk about, is what we call a current ratio. So a current ratio just measures the ability to pay short-term obligation by using short-term assets. That is, the assets that probably can easily be converted into cash within 1 year. And can we use those assets to cover these short-term liabilities that we have, which, for example, we have to cover or we have to pay within a year? So the good liquid ratio that we use, normally being used, is the current ratio. So how we find the current ratio? For example, when they ask you the exam, can we find the current ratio for this particular financial statement? You're going to look at the current assets, and then you also look at the current liabilities. Then you're going to divide the current liabilities into the current assets. So you look at the total current assets, divide by the total current liabilities, and that will give you the current ratio. So what happens when you get a ratio which is greater than 1? So when a ratio is greater than 1, the current ratio is greater than 1, which simply tells you that there's a good short-term liquidity. The company is in a good position to be able to cover short-term liabilities by using their short-term assets. But when the liquidity, let's say, is less than 1, is 0 point something, it means that's the potential for liquidity problems. So that's not good news. There could be some problems right there. So that is about the current ratio, and of course it's going to vary from industry or company to company. So current ratio, we talk about the current assets divided by the current liabilities. We'll look at an example on how we can calculate this from a financial statement. So before we look at an example, I want us to talk about the next type of financial ratios that we are talking about. So the first type, you can mark it down, is liquidity ratio. That's what we talk about. And the liquidity ratio that we've just talked about is the current ratio, which we find by dividing the current liabilities into the current assets. So the next ratio we're going to talk about, the ratios, we'll talk about efficiency ratios. So the efficiency ratios, we'll talk about the two types of efficiency ratios. So number one, we'll talk about the receivable turnover ratio, and number two, the fixed asset turnover ratio. So what are these ratios and how can we calculate them? So the receivable turnover ratio, this is the ratio which indicates, it's a group of efficiency ratios. It indicates how efficiently a company can collect its receivables. So what's a receivable? Receivable is an amount which a company is going to receive from a client or from its customers. So how good or how efficient is a company when it comes to collecting those receivables from clients? So that is the job of the receivable turnover ratios, just to give us that idea. And then how do we calculate the receivable turnover ratio? So the formula for the receivable turnover ratio is the net credit sales. Look at the net credit sales. Sometimes you're going to have total sales, or you're just going to have sales on top. So you look at the net credit sales, then you divide the net credit sales by the average accounts receivable. So when you talk about the average accounts receivable, these are the amounts which have been smoothed out that a company is able to receive, let's say in a year. So for example, how do we get the average accounts receivable? So we're going to find the amount that is collected, let's say at the beginning of the year, and then we also look at the amount that is collected at the end of the year. Then we add them and divide by 2, and we get the average accounts receivable. Again, we look at an example on how we can find or solve some of these from past paper questions. So that is the receivable turnover ratio. It indicates how efficiently a company is going to collect its receivables, and that is a calculation. Look at the net credit sales divided by the average accounts receivable, and I'll help you to know on how we can remember these formulas easily, or how I do remember the formulas easily, so that I do not forget the formulas, so that you can just master them. And the second efficiency ratio we're talking about is a fixed asset turnover ratio. That is a fixed asset turnover ratio. So the fixed asset turnover ratio, or FAT, as I like to put it so I can easily remember it, simply talks about the ability or effectiveness of a company to use its fixed assets and being able to generate sales by using its fixed assets. So the ability or how efficient a company is when it comes to using its fixed assets to generate sales. That is the fixed asset turnover ratio. How we calculate, of course, we look at the sales, we divide by sales or net sales, and then we get the net fixed assets, or the net fixed assets. When it comes to productivity, we're talking about the property fixed assets, we're talking about property, machinery, equipment, all those things. So how efficient is a company to use these things to be able to make sales? So we look at the total sales divided by the net fixed assets, and probably you're going to get this information from the balance sheets and other financial statements or financial documents, but mostly we're going to get them from the balance sheet. Okay, so these are the three ratios that we've talked about in this video. In what I want to talk about, a fixed asset turnover ratio, which talks about how efficient a company is when it comes to using its fixed assets. We talk about machinery, equipment, and to be able to generate sales, divided by net sales or total sales. And how we remember this, basically, let's say we have a few things that we can use to be able to remember this. So for the fixed asset turnover ratio, for short, I usually put it as FAT, fixed asset turnover ratio. And how we easily remember this, I will just say SANAP, SNAP. So know that is to be sales divided by net assets, or which is for property or productivity. So this is how I remember this. For receivable turnover ratio, this will be the net credit sales divided by the average account receivable. So I'll just say NE divided by average accounts receivable. So just say near. So that is the receivable turnover ratio. I remember it by this. And the fixed asset turnover ratio, I remember it by FAT is equals to SNAP, which is sales divided by the net net fixed assets, which P just means productivity there. So fat SNAP, near, and then we can talk about the current ratio, which we mentioned. The current ratio gives us how we calculate current ratio is equal to current assets divided by current liabilities. That one is pretty much simple to do. So these are the three financial ratios that we had talked about, and probably let's just look at an example on how we can find these financial ratios. So what we are seeing here is a balance sheet, and in this balance sheet, probably let's get, for example, we want to find the current ratio. What will be the current ratio from this balance sheet? As you can see, the balance sheet here is perfectly balanced. Total assets to 10, then we have got the liabilities to 10 their assets, and let us find the current ratio. So when you look at this, balance sheet, current ratio, we said current ratio is equal to the current assets divided by the current liabilities. So current ratio in this instance will be, what are the current assets? So current assets, total current assets. So assets, current assets, we've got cash 50, we've got accounts receivable 32, we've got inventory 17, so we've got about 89. So 89, that is the total current assets divided by current liabilities. So what are the current liabilities? And when we look at total current liabilities, you have total current assets 89, total current liabilities 49. So we're going to divide this by 49, and what you're going to get is your current ratio. So for the current assets, that will be a current ratio, that will be 89. 89 divided by 49, that gives us something like 1.2. So the current ratio for this company from their balance sheet is something like 1.82, 1.92, 1.92. So it's 1.82. 1.82. So that is how we find the current ratio. So again, the current ratio, you look at the current liabilities, the total current liabilities. So here we're lucky we've been given total current assets, and then we divide that. We divide the total current liabilities into the total current assets, as that is how we find the total the current ratio. So that is the current ratio. So again, we say that the current ratio, when it is greater than 1, it means the company is doing very well when it comes to covering short-term liabilities by using short-term assets. When it's less than 1, is not doing very well. Of course, that will depend or vary from industry to industry, and what in the context of what we're talking about. So 1.82 could mean we are well on a good course. So next we can find we can try to find for the receivable turnover ratios, we need the net credit sales, then we divide by the average accounts receivable. I think we'll make a video in this one. And then for the fixed asset turnover ratio, we need the net sales divided by the net fixed assets. So the net fixed assets, we're talking about the property, machinery, and all the fixed assets that the company has when it comes to productivity, and then we divide by the net sales. So for example, let's look at our balance sheet again, and then the question is they're telling us to find the fixed asset turnover ratio. So for that, we need to find the net sales. And how do we find the net sales? We look at the financial statement, and in this instance, we look at the income statement to get the sales. Then when you get the sales from the income statement, we divide by the net fixed assets. So let's look at the income statement. So this is the income statement. As you can see here, total sales is 312, cost of sales is 210, gross profit 102, research, development, depreciation, amortization. Then we have got the operating income, earnings before interest and taxes, EBIT, interest income expenses, and pre-tax income. And then what we want here is to get the total sales. So we just look at this. We have our total sales there, which is 312. That's our total sales. And then we have, that is what we need for us to for net sales, total sales, basically one the same thing in this case. So 312, the total sales according to our net our income statement, or profit and loss statement. We divide by the net fixed assets. So when we talk about the net fixed assets, we're talking about the balance sheet, because this is where we get the assets and liabilities. So we change, we go from the income statement, we come to the balance sheet, and then we look for the assets there. Then we look at the net long-term assets, fixed long-term assets. So I've got net property, plant assets here is 121. So total long-term assets from this we have is 121. So we're going to divide the total sales 312 by 121. So what is the ratio that we're getting here? So when you divide 312 by 121, you get something like 2.6. Should be something like 2.6. So we can see from here that 2.6 or 2.5, let me just say to one decimal place, 2.6. So 2.6, but probably we can do two decimal places to be more. 2.58. So this is the fixed asset turnover ratio. So again, how we remember the fixed asset turnover ratio, the SNAP, that's the sales divided by net assets. It comes to productivity, and here is the net credit sales divided by the average accounts receivable, that is for the receivable turnover ratio, and the current ratio is just the current assets divided by the current liabilities. That is how we remember them, or what we use to easily remember these. Okay, so that is it for the first types of financial ratios in this lesson for financial analysis. Number one, we talked about the liquidity ratio, current ratio as a liquidity ratio. In number two, we talked about the efficiency ratios, that is a receivable turnover ratio, how good or how effective a company is when it comes to collecting its receivables. How near can they collect their receivables from clients and customers? That is the job of the receivable turnover ratio. Fixed asset turnover ratio is how a company uses its fixed assets to generate sales, and it's calculated by net sales divided by the net fixed assets. Current ratio talks about how effective a company is when it comes to using its short-term assets to cover short-term obligations or liabilities. So we'll see you in the next video for the next part on efficient or financial ratios, and I'll talk about the next types of ratios. So see you in the next video.